Alright, let's talk about key reference area number 3, which is high volume nodes. And when I say high volume, I'm talking about horizontal volume. So let's just jump right into the charts and take a look at what this is. Alright, let's take a look at what this key reference area is all about. What you'll see on my screen is a volume profile chart overlaid on top of the candlestick chart. And I've done this to show a different perspective of this balance area. What you'll see here is that market was balancing sideways. We were going sideways here, all the way here. So this was like a 3-day balance area. Alright? The volume profile just shows it from a different perspective like we talked about earlier. What you'll see here is the red part is showing you where value was. This is pretty much where 70% or so of the volume in this area took place horizontally. Alright? So it just lights up as red. Like the most concentrated part is highlighted in red. And the most concentrated part, like we talked about earlier, signifies where the value area really was. Alright? And then this green line right within it is what's often referred to as the volume point of control. This just means that this particular price, which in this case happened to be somewhere around 1377 or something like that, this particular price had the most horizontal volume, i.e. the market spent the most time going through and transacting trade at this price in this area. And so let's see how this acts as a key reference area. While we're inside this area, right, we're just balancing, the high volume node is building. Now, when I say high volume node, which in this case is the green one, I don't mean the exact one. I mean this whole area, right? Like I've said before, it's never precise in the markets. Don't look at exact ticks. This is just something, take it from me. I've learned the hard way. Do not look for exact ticks. Just use general areas, and that's what suffices, because this isn't a textbook. This is reality, and the market is complex. So when I say high volume node, you can basically look anywhere from here, a little bit below the green line, all the way up to even here. It's just the general area of the most volume. All right. And so when we're inside this balance area, this is still developing, right? It's developing, and this is what's creating this volume profile. It becomes a reference area when we move out of it. So we look at here, right? Price here broke down out of this value area, out of this balance. And so something had changed. The underlying supply-demand fundamentals, the psychology of the market, the sentiment of the players had changed. And they pushed price down away from value. But what often happens is that we don't just take off straight away. Now sometimes, again, like when there's major directional conviction, we do. We break out and we just shoot away, either downside or the upside. But what often happens is we break down, test the lower part of this balance area, right? We break down, and then we come back to test the previous high volume node or the high volume area. This is typical market behavior. Now the key thing here is when we come back to test it. So we kind of tried to break down here, they rejected it, put in a little buying tail, and then we kind of just go sideways, and here we try to go back up to this area. Now typically here, this is where it acts as a reference area, a key reference area, and it gives us information. How the market reacts to this area gives us information, like all key reference areas do. If the market comes back here and just sits there and balances again, then this whole balance area could be just going to continue, and this downside push could have just been a fake out, right? Sellers tried to push it down, but buyers said no, this is below value, we still believe value is here. Buyers were stronger and they push it back up and it goes sideways, right? That could happen. But if this initial test down is going to prove true, and if this is going to be the eventual direction the market's going to take place, a key tell that this is going to happen is if price rejects this high volume node pretty quickly, which is what happened here. Now you got to think about, why is this a key reference area and why does this happen? Well, again, you got to think about market participants, like I've always been talking about and like I'll always keep repeating until you understand it and internalize it on a deep level. So this high volume node was signifying value. This is where buyers and sellers were transacting. There was price acceptance here, and they were generally in agreement. But because the market spent so much time here, that means a lot of players were involved over time. And on this initial push down, a lot of the people that have bought here are now showing a loss. Now you got to realize these aren't all day traders that are just going to exit quickly if they're showing a loss, right? There's going to be a lot of bigger institutions or whatever it may be that may have been buying here, and now the market shot down, their position's at a loss. So when this thing comes back up here, if their view of the market has now changed, they'll often sell their position at break even, right, to get out at no loss. And what ends up happening is this selling causes the move to go back down. And of course there'll be other sellers that were already the ones that were pushing it down also selling because they still believe that the price should be lower, and it ends up dropping. Now let's assume that the real fundamental outlook hadn't changed and that this was just a downside fake out and it was coming back up. Well, even if this drop was not going to happen, right? Most of the time, the great majority of the time, once you reach this high volume area, you're gonna have a reaction at least sideways, i.e. price is rarely gonna just shoot right through it. It's gonna stop and kind of move sideways or react, maybe not completely reverse, but move sideways. And the reason why is that there were so many people and traders and institutions transacting trade in this area and had been established as a value area for quite a while, that now when price moves back here, there's naturally going to be a lot of market participants with a vested interest at what happens in this area, which is why price is rarely going to just shoot right through it. But, and here's the thing, if it does shoot right through it, that's also great information. See, that's the beauty of key reference areas. They always give you information no matter what happens at them. And if price were to shoot right through this with barely stopping, right, that would be telling you that there's a lot of strength in the market. And that would be telling you that the likelihood is that this thing's going to go up high and fast. Because now everyone who had sold in this area and was short still and still had short positions, all right, once this thing shoots up, they're all going to be stuck on the wrong side of the market and they're all going to have to buy back their shorts, and that's just going to push prices much higher. And not only that, but to just move right through an area where the market had been doing a lot of trade, a lot of value is being seen there, tells you that there's a major change in perception that was quick. It was right here and it just shot right through, right? So that gives you information that there's real strength there. So as you see, you get information no matter what it does. If it shoots right through, that gives you information about the strength of the market. If it rejects it quickly, that shows you that the market is weak and that this value area is going to be rejected and move to the downside. And you know that what's common, at least, is that price will react here, right? So you're always thinking about, when you get information, you're always thinking about what's common, and when the uncommon happens, that gives you a great deal of information. The uncommon here would be that it shoots straight right through. That gives you a good deal of information. The common is that either it's going to react quickly, which is a tell that indeed this initial down move was a heads up for the bigger down move, or it's just going to react and move sideways at least, or have at least some reaction there. Now a couple notes about this. The first is that it doesn't really matter how far we move away and how much time is spent away from this previous high volume node. Alright, here it was very quick. It was in the same day. It tried to break down, it couldn't, it retested it, and it took off down, and then it went down the day after, right? It was very quick test. But sometimes it'll be days and even weeks, and we'll be well, let's say we'll have broken here and we didn't come back and test it right away. We just kept going right through. It was a very directional conviction, right? Well, weeks later, we might come back and test this area, and it'll still often prove to give you a reaction. Now, here's the general rule of thumb, all right? The more time that passes, the bigger this time period should be for it to influence it. So let me give you an example. If this was only a 3-day balance area, right? And it's a high volume node here. And we go down for 2 months or 3 months on a major down move. When we come back, this is not going to act as much resistance. It was only 3 days in the midst of 3 months of movement. So this is going to be pretty small, right? You just think about the time frame. You're going to zoom your chart out, and this thing's going to be barely viewable. So it's going to be a little blip on the screen, and it's not going to matter much. But in this case, if it's only a few days later, then yes, a 2 or 3 day volume area is going to matter, right? Whereas if you're looking at a 3 months chart, you're going to want to see where is the high volume node for, let's say, a several week balance area. Right? They all match up. If you're looking at a large time frame of 60-minute bars or a daily chart, and you're looking at 3 months out, then the volume that's going to matter on that time frame, the horizontal volume, is going to be also on a bigger time frame. It's going to be where it was many days and created a lot of volume. If we're looking at a 1-minute chart, well, then the previous day's value area could make a difference. And let me give you an example. Let's look at this day right here, right? This is a volume profile of just 1 day. It was balancing, for about 1 day here, right? The next day, we started out here, we moved down, right? We try to break down through this value area, potentially making a move lower, but then we reverse and we come back to test this volume area right here. Well, what happens right when we touch this area, this general area? Look at this reaction. Now, it's not big because we're looking at only the previous day. But when you zero in on this day, and let's do that right now, you see that when price hit this general high volume node here, right, it did have a 2-point reaction down. Now, that doesn't seem like much, but if the whole day's range is about 6.5 points, 2 points are the third of the day's range reaction. So it matters here. And of course, it's the same on the short side or the long side. So we were looking at before 2 examples where it moved up, hit it, and reacted down. Here, let's look at this. This was 1, 2, 3, 4, 5-day balance area, right? And it built in its high volume node around this area right here. Okay. The next day, the price was up here. It started building value higher. It kind of broke out to the upside. Couldn't really tell if it was going to be a major breakout because there wasn't that much conviction. It was just kind of going sideways. Then near the end of the day, it came and it tried to test this previous high volume node of the last 5 days. Well, what happened? We quickly rejected it. You see, the price quickly rejected and kept on moving the next day up. Well, what this shows, again, market information, is that since we quickly rejected it, higher prices are likely. That means this initial breakout, this view that value is no longer here, is going to prove correct most likely. And as we see, the price did end up going quite a bit higher. Alright? Now let's take a look at and see how these areas here still matter a few days later. Right? Not on a quick one. We'll be showing quick ones like during the same day. We move out, then we quickly retest it. Move out, quickly retest it. So let's take a look at what happens a few days later. Well, here we are a few days later. So the market kept going up 1 day, 2 days, 3 days, 4 days. It hit way higher. It went about 20 points higher than this, right? Then it started coming back down. And let's take a look at how it reacted to these days that were now many days before. So when the market finally reached this previous high volume node here of these 2 days, right here, look at that, it had a reaction and bam, it went up about 10 points. Okay, and then when it came to try to test this previous one, which is bigger, which is 5 days worth, this one's more significant. The bigger the time frame, the more significant the support now is going to be. So it came down, it hit it the first time right here, right? It bounced a bit, hit the middle of it, right? Another time, and then bam, shot up. And this time it shot up quite a bit because this was a bigger reference area. So the size of the reference area does matter in telling you how big the reaction is going to be from there. And one last thing I want to say about this whole subject, about all key reference areas for that matter, is that once we break through them, they become invalidated. And let's see what that means. So for instance, we're looking back again at the first balance area that we looked at in this example, where we came down, tested it a bit, and then dropped, right? Well, what ended up happening here was that, so the market made a low, and then it shot right through this, and it gapped right through the whole thing. And it didn't sit here and kind of trade sideways, and it didn't react down, it just gapped right through it. Now, like I had said before, that means when it gaps right through it, that shows a major change in the perception of value, and we're probably most likely going to get much higher prices, which ended up happening. But the key thing here is now that it has gone through it, right? If we were to come back and test this, this would no longer be a relevant balance area. Why? Well, because we had gone through it to the other side, right? It's only relevant as long as we're on one side of it. So here it was, we go down to the downside, it's going to be a relevant area that causes reactions to the downside as long as we're here. Once we go back through to the other side, it's no longer a relevant area. So don't think now that if it comes back down, it's still going to be important. That's it, they've invalidated it. This whole upward price move took out all the previous participants in this area. And now the whole picture is different. And this applies to everything. It applies to tails and range extremes too, right? If we have a certain high of the day, let's take a look at it now, right? So for instance, at this point in time, this was the high of the day. If we were here and we came back down, right? This was the high of the day. Once the high of the day is taken out, this is no longer a valid key reference area. This now becomes the key reference area, all right? So that's just something to note, to understand how these things work. And so the key takeaways are that the bigger the high volume node, i.e. the more days it encompasses, the more important this area is, the bigger of a reaction we can expect there, right? That's number one. Number two is that every key reference area gives you information no matter what it does. And number three, once we finally do go through to the other side of a key reference area, it's no longer valid, and then we don't look at it anymore. We look at what's happening next and what new key reference areas are being formed.